And how about you? Maybe talk a little bit, so for 3 companies you've been out there, and I understand that you've intentionally raised from angels. So maybe talk a little bit about that.
Yes, to me it was, I always, when I started these companies, I always thought they were targets for venture money. First company I did was a company called Lumenti, for which I raised about $13.6 million from venture capitalists. And initially, our angels were my co-founders, relatives, and my relatives and myself. So what we wanted to do was really take, $250,000 or $500,000 and prove our concept so we could get a higher valuation in the And that, I thought, was the sum total of the reason to raise angel money. That we need some seed money, whether it's coming from me or a group of people, interested people. We didn't really think about the value they could add. It was just these people are going to put money in without any questions, without even a meeting, they just send a check. Okay? And they're never going to talk to us again. They're never going to talk to us again. And what we're going to do with this money is we're going to, go talk to prospective customers, maybe build a prototype, and then spend the time in the office and then go talk to venture capitalists. So my goal was always to get to a VC. Because in the first company was building an enterprise software company, it was rumored that we needed, $50 million to really build an enterprise software company. We managed to have an exit after raising $17.6 million, or about $366 million. So we were happy, including our angels, who made a ton of money. And we always did this as a convertible, because it was a small amount, so they got us a Series A valuation with a little warrants. So the second company, same. I was building an enterprise software company which evolved into a SaaS company. Again, it takes a lot of money to build those. And so I was in a position to put more money as an angel myself, but also, again, friends and family, co-founders, relatives, that sort of thing. Generally, the first group that had invested in the first company came along. And then I did another company called Offerpal Media. And over here, I also took a little bit of angel, but I found that this is, Web 2.0, I could actually get the product built pretty quickly without too much angel money given. And again, my target was just to get to that, VC round at the highest valuation possible. So I raised, $4.6 million in my Series A after putting in, $250,000 of angels from various same friends and family. And never thinking that the angel would add any value, except send the check and don't bother me. And it turns out that Offerpal, became profitable in 3 months. And started to hit triple-digit revenue. We never touched that funding. And so when I look back at it, I said, we shouldn't have raised any money at all. Or we should have really gone to some angels who could add value and maybe raise $1 million to make us feel good and attract talent. And this wasn't a VC deal at all. Not that you can hit profitability in 3 months. Maybe you go for venture then, and then you get a much higher valuation. So really rethinking my whole, just take the non-obtrusive angels and then go straight to VC strategy. I'm completely rethinking it for venture number 4.
Good. I was going to be thinking of venture number 4 as well. And Bob and I know that you're both pretty hands-on, so maybe we can talk a little bit about the difference between a value-added investor and a non-value-added investor. So, in your opinion, how involved are you? You're pretty involved with your companies. What are some of the things that you're doing for your companies as you invest in them?
So let me take the first shot at it because my answer is going to be non-traditional. Let me qualify. I am not hands-on. I am high value, or at least that's my goal. And let me also clarify what that means. So a lot of people ask me as an angel, well, how much time do you spend with your company? And as you well know, this is not about quantity, it's about quality. I feel that there are 4 or 5 major milestones in the company's history, and to the extent that I can help in those, and not really cause any trouble with the founder and always be there when the founder needs me, that's the highest value I can add. The first milestone is founder visit. So the most important thing I can do for the founder is, like Todd said, getting that lead and getting the right investor mix is really important. And a lot of times, because the founders are also running the company and growing the company, they don't have time to really understand the investor universe and figure out what is the best match for them. So that's one area I can help. The second one is hiring and critical decisions in the company. And when I started, I've seen how some of these things could be greatly done at Google, and I think that was a very valuable experience. I also went to business school, but I feel a lot of the significant things I learned at Google, how they did things out of the box. In terms of other value add or important milestones in the company's history, then there are like important hiring decisions or sales decisions, so that's why I try to come in, make connections. And the very last one is when actually a liquidity event happens. I don't think we see as many IPOs today, but the acquisitions are pretty common, and that's a very, very tough process, and being able to get exposure for my companies, increasing their potential likelihood. I can spend 1 hour on a phone call, actually make an exit happen or double the company's value. It's worth more than 1,000 hours I can spend with the founder. And also I think there is value in not calling the founder every week, what have you done for me lately? You know, I mean, kind of leave the guy or, you know, woman in peace, like they can run their company, but like be there for the important things. So I think this is one of the important things. There's always this talk of like value add VC, value add angel. I am very pragmatic about that. I mean, it's all about the real value you can create for the founder. It could be one call, it could be a connection, but being able to follow through that and execute that is very important.
So would you ever invest in a company that you felt you couldn't add value or that really was looking for a passive investor? That
I would not, because the other thing I was going to say, and I don't want to get too far carried away from the conversation, but you know, you have to understand that venture capital is not about risk business, it's about risk reduction business. So we're looking for great opportunities, huge traction, huge growth, and how we can reduce that risk so we can make that outcome as likely as possible. So if I can add any value, then I'm dumb money, and there's a lot of capital out there, so there's no sense for me to get involved, because basically the very first thing I'm trying to do is, can I help this company in any way to reduce the risk and increase the value of the investment and create a win-win situation?
how about you, Bob?
I agree totally. In my experience, and I've invested in 50 companies too, although over a much longer time horizon, there's an inverse relationship between the level of investor involvement and likelihood of success. The best companies have very strong entrepreneurs with their own minds, who are very clear about where the company is going, and happy investors who show up at board meetings and enjoy the results. High fives all around. One of the first companies that I invested in was subsequently invested in by a venture investor who is no longer in the business, and you'll understand why when I tell you this anecdote. For the first 18 months of this person's management of the investment, he had the CEO of the company call him every day. Every day at 4 p.m., the CEO would call, explain what he had done that day, and explain what he planned to do the next day. And amazingly, to the CEO's credit, the founder CEO's credit, the company was a success, but he hated every minute of it. And the guy, although he perceived himself to be highly involved and highly value add, he was actually a value, limiter, value detractor. So, I agree completely with Aydin. You want to find investors who have experience, who are there to provide helpful advice and counsel when you need it, and who are not stepping on your toes when you don't need it.